The truth is, if we can't make a decision in 5 minutes, we can't make it in 5 months. We're not going to learn enough in the following 5 months to make up for the fact that we went in deficient in the first place. So it's just not a problem around Berkshire. If we get a call and somebody says either they've got a business for sale, or well, that's what we're going to get on the calls. Or if I'm reading a paper or a magazine or an annual report or a 10K, and I look at a price and there's a significant differential between price and value, we move right then. And Charlie and I don't need to talk to each other about it. I mean, we both think the same way, and we have generally similar spheres of knowledge. Charlie?
The answer to your question is we can make a lot of decisions about a lot of things very fast and very easily, and we're unusual in that respect. And the reason we're able to do that is there's such an enormous other lot of things that we won't allow ourselves to think about at all. It's just that simple. I mean, I have a little phrase when people make pitches to me, and about halfway through the first sentence I say, we don't do startups. They don't exist. Well, if you blot out startups, there's a whole layer of complexity that goes out of your life. And we've got other little blotter out systems. And using those, we finally find out that what remains is still a pretty large territory that we can handle. You think that's fair, Warren?
Yeah. And there are an awful lot of giveaways that people in the first sentence or two throw out that, we just know we aren't, it isn't going to work. And we waste I would say, we waste a lot of time, but we waste it on things we want to waste our time on. And we're very selective about that, and then we're good at it. We waste a lot of time. But we're not going to waste it on things we don't want to waste it on. I said, we therefore need someone genetically programmed to recognize and avoid serious risks, and then I put in italics, including those never before experienced. And then I said, certain perils that lurk in investment strategies cannot be spotted by by use of the models commonly employed today by financial institutions. Well, I think that proved to be somewhat prophetic of what happened last year. All of these places had models. I mean, the major banks, the major investment banks, and they would meet weekly at a risk committee probably and go over their models, and all of the statistics would be printed in nice columns and everything, and they didn't have the faintest idea what risks they were involved. You really need, in the investment world, someone very solid, someone you trust, reasonable analytical skills, but you also need someone that actually can contemplate problems that haven't popped up yet, but which are starting to become possibilities in terms of new financial instruments or new behaviors in markets and that sort of thing. And that's a rare quality. I mean, that inability to envision something that doesn't show up in your past model, can be fatal. And Charlie and I spend a lot of time thinking about things that could hit us out of the blue that other people don't include in their thinking. And we may miss some opportunities because of that, but we feel it's essential when managing other people's money, or for that matter, managing our own money. So I would say that you might go back and read the 2006 annual report again, but those are the criteria we're looking for, and we have identified as being met by the four people we're thinking about. Charlie?
Yeah, you can see how risk averse Berkshire is. In the first place, we try and behave in a way so that no rational person is going to worry about our credit. And after we've done that and done it for many years, we also behave in a way that if the world suddenly didn't like our credit, we wouldn't even notice it for months. Because we have such liquidity and are so unlikely to be unable to be pressured by anybody. That double layering of protection against risk is like breathing around Berkshire. It's just part of the culture. And the alternative culture is just the opposite. You call a man the chief risk officer, but often he is functioning as a guy that makes you feel good while you do dumb things. So he's like the Delphic oracle that convinced the Persian king to attack somebody or other. I mean, he's just a dumb soothsayer. And how can a guy be dumb when he's got a PhD and he can do all this advanced math? Well, you can but you can. It's perfectly well. All you've got to do is crave system and computation so much that you torture reality into fitting some model, mathematical model, which really doesn't match, particularly under extreme conditions. And then because of this work that you're putting into everything and these computations about daily trading risk and so forth, you feel confident that you've clobbered the risk, but you haven't. You've just clobbered up your own head.
Yeah, we really want to run Berkshire. You know, I'll even applaud that one. We really want to run Berkshire so that if the world isn't working tomorrow the way it's working today, and it's working in a way nobody expected, that we don't have a problem. We do not want to be dependent on anybody or anything else, and yet we want to keep doing things. So we think we found a way to do that. It may give up some of them. Well, it obviously gives up earning higher returns 99% of the time and maybe 99.9% of the time. Obviously, we could have run Berkshire with more leverage over the years than we have, but we wouldn't have slept as well, and we wouldn't feel comfortable. We have a lot of people in this room that have almost all their net worth in Berkshire, including me, and we wouldn't feel comfortable running a business that way. Why do it? I mean, it just doesn't make any sense to us to be exposed to ruin and disgrace and embarrassment and for something that's not that meaningful. If we can earn a decent return on capital, what's an extra percentage point? It just isn't that important. So we will always try to behave in a way that A, is not dependent on anybody else evaluating the risk except for us. It cannot be farmed out. And you've seen what happened to some institutions where the management thought they were farming it out. And, if that means a reasonable return instead of a slightly unreasonable return, we just accept it.
You have been occasionally compared to, or rather, Carlos Slim has been occasionally compared to you for other reasons than your love of the game of baseball. Can you please share your thoughts on him?
Well, he came up once with two of his boys, and we had lunch, but that was probably 15 years ago. So I really have no special. I mean, you probably know a lot more about Carlos Slim than I do. I read the news stories and all of that, and we had a perfectly pleasant lunch, but that was a long time ago. And Charlie, do you have anything?
No, I think you speak for the total knowledge of both of us about Carlos Slim.
We'll go down the rest of the Forbes 400 for you, too, if you would like.